Welcome to Upside, where we dig into the real stories that live behind the headlines affecting European venture. Today, it's Mads, Andrew, and my good self, and we're talking about seed to A. Getting to Series A, is it getting out of reach? Germany has a new $100 billion fund. We're going to look at Germany's mega action over there. UK rate cuts, it was today. Today is Thursday, the 7th of August, recording. There was another rate cut, so we're going to have a look, see what that means for the UK economy and investing in startups. OECD, who has been tracking corporate investment. We've got some bad news from the OECD. We're going to take a look at that and see what that means for us. The EU Chips Act 2.0. The EU is trying to reignite a pretty failed attempt at the Chips Act, so let's see what's cooking there. And then we have a massive AI corner, which I'm going to lean on you, Mads, for.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
So, gentlemen, we are going to start right at the top, as always. Easy A's, Series A. Are they now harder to reach? A little bit of context. So this looks like a story from two sides of the pond. So what's happening in the States, what's happening in the UK? Some context for us. It's been reported that the average US startup now takes about 2.5 years to get to Series A, over a year and a half in the last decade. Graduation rates, and this is according to the Wall Street Journal. So graduation rates have sharply declined to around 11% of startups in the last 2000 to 2025, the last 15 years. So about 11% of startups now graduate. That's more than halved. In the UK, the numbers aren't quite as hectic. So UK, Europe, almost double the number make it to Series A at 18 months. However, they're smaller rounds at about 2 to 3x. AI is obviously reshaping the narrative. I'm going to ask both of you to have some thoughts on that. And the macroeconomics is weighing. So we've got interest rates, we've got a weak IPO market, and generally still fairly sluggish investor activity. Also, quite interestingly, bridge rounds overtook the full Series A rounds in Q1 2025 at about 44% of all price seed rounds. So maybe there's an angle there. And some of the zombies, some of the hangers-on are still skewing the data. So, stats and damn stats. What's real? What's not real? Mads, for you first. What's happening in this slightly murky data set?
So, we're seeing a global pattern, and we've seen that since 2021, 2022, where there was a massive funding glut. Effectively, we had too many companies that were funded in that period, and so many of those had to flush through for things to start to stabilize again. When you ask about the data and what is good data, we look a lot at the Carter data. So because Carter has data on all the companies and all the funds that live on that platform, and because it's pretty representative of the US venture ecosystem, and because it's not self-reported, it tends to be very high quality data. And so Peter Walker from Carter, he does a lot of great analysis. And the data he shows there actually shows that graduation rates have been improving this year. So it contradicts the Wall Street Journal's sort of doom narrative slightly. And I would say anecdotally, we're seeing the same improvement in Europe, but we still see a lot of bridge deals. There's no doubt about it. And I'd say this is really a feature rather than a bug of the system. Venture capital was never meant to be easy. You're building global category leaders. Kind of the Olympics analogy, it just, usually holds, right? If you want to have excellence, it requires extreme selection. I would say even throughout the drought, great companies have gotten funded regardless of the macro. And so kind of to some extent, what we're seeing now is some of the overhang from 21, 22 has been flushed through the system. And so that improves everything. The implications, as we often say, are heads down and build. It is positive to see graduation rates improving, even if it's not easy yet. But the quality bias is resetting to sustainable levels. And I'd say the message to founders is just you focus on building great things, and good things will happen.
Any of this either for or against the argument that Series A is getting further and harder and more difficult to achieve? What have you seen on the ground with your portfolio?
Lies, damn lies, and statistics, right?
Yeah,
right. So for me, this is a labeling thing, because at a glance, the data would almost suggest that actually it's easier to raise a Series A in Europe than it is in the US. And categorically, that is not the case. It may well be more likely that the Series A rounds in Europe are actually smaller than in the US. And I suspect many of these Series A rounds in Europe are actually equivalent to a seed round in the US. So the idea that somehow European time from seed to Series A is only 18 months and it's, nearly twice that in the US, I think it's a bit of an anathema. It's inevitable that given the bubble we had a few years ago, that you're going to see sort of perhaps a higher death rate. You're going to see a bunch of companies that perhaps even got seed funding that never should have, and they are struggling to get seed funding or even dying. So that's just the ebb and flow of the market and capital availability. But I don't really care about these numbers, to be honest. I think it is still easy to raise in the US. Rounds are still bigger in the US. And you're going to get this variation, but for good companies, there is always money available. And sometimes it's just incredibly hard. We've had a company recently that raised, thought it was going to die. It's in the space tech sector, spent 6 months trying to raise, and then came out with a fantastic set of investors and has done a 4 to 5 billion seed round. So, if you're a founder, you've got to focus on fundamentals, and it's hard.
I mean, we behind the scenes talk about this a lot. It does kind of now depend on what you call pre-seed, seed, A. I think AI has obviously kind of morphed the bucket and mushed things together. And when you look at these aggregated data sets, I think there is a massive challenge as to the quality of the data when you start to average out and mean or median and then work things out when there are so many vectors baked in. So maybe that's a podcast for another time. What is pre-seed? What is seed? What is A?
Well, also, to that point, Dan, like European, one thing you asked specifically, what do we see? We see that UK and European startups tend to do a pre-seed, a seed, then they'll do a seed extension, they'll do a series seed, and eventually they'll get to a series A. In the US, you generally do see people raising larger seeds, and then they get to that series A or they don't. Of course, there are exceptions, but where are you measuring this Series A from versus the seed round? And obviously, if you've done 3 seed rounds in the UK and Europe, and you're measuring that last seed round, or you've announced it as one lump of money that came in over 18 months, then your road to your Series A is going to be shorter than if you did a straight seed and then 18 months raised in the US a proper Series A.
All kinds of complexities and issues with that, of course. One part is that by forcing founders to raise so many bitty rounds, you have so many rounds of dilution. And you can say to some extent you can fix that with options at a later date, but you then penalize the early investors that were in early and will get washed out because they won't be topped up. To some extent, we are a little bit at the mercy of sometimes we say, we have higher capital efficiency in Europe, our companies need less capital, but you do need capital to compete globally. And if you chop it up in so many bits and have so many rounds of dilution, I do think there's a negative impact to the ecosystem.
Yeah, undercapitalization is a bit of a problem.
Exactly.
Right, let's talk about Germany, because Germany's having a bit of a monster time. So they are preparing to launch a 100 billion euro investment fund dubbed the Deutschlandfonds. I'm going to try my very casually racist German accent. They want to secure strategic sectors such as defense, energy, and critical raw materials. Obviously, no great surprises there to us. It makes complete sense at this moment in time. The fund will initially be backed by at least 10 billion euros of public money. And the idea is then to unlock 10x of private capital. So Germany's going for it across the board. They're aggressively. They have so many initiatives. So one other is they approved, I think back in March, the 500 billion euro fund over 12 years focused on infrastructure and defense. And I think, Mads, you can correct me if I'm wrong, but this is in addition. We've got 100 billion euros of that 500 billion, which was earmarked for climate and energy transition. The debt brake was released back in March, I believe. So that gives defense and security the ability to spend even if it's over 1% of GDP. And obviously, this is all a reaction to Russian aggression, US uncertainty, and Germany kind of ramping up the books. So private sector seem keen. Apollo's looking to invest heavily. They're looking at 100 billion euros. This looks all super, super duper positive. I quite want to be German. But Andrew, what is there anything that the UK could borrow from this Germany plan, do you think?
Well, you can argue maybe that it's the other way around, because we had the National Wealth Fund that was launched, I think, end of 2024, which is the UK strategic public investment forum alongside that, which is supposed to kind of provide a way to synchronize up all these different government initiatives. So that's chaired by the Treasury and CEOs of the National Wealth Fund, the British Business Bank, Innovate UK, Great British Energy, to try and they have the same model. I think it was like 5-1, or they promised three pounds of private investment for every pound invested in government money. So there's a lot of different government initiatives, and I think it's, as ever, it's going to be the devil's in the detail on how this cash is deployed, who's making the decision to deploy it, and where it's being deployed.
Mads, give us some more of the backstory, and then maybe perhaps lean into the startup and investment specific aspects that are gonna affect our world.
So much to unpack here. I mean, just going back to kind of two of the things you mentioned, which one is you've got Russia and Russian aggression, and the other is US tariffs, kind of the quote unquote deal that has just been done between the EU and the US, and how all these things are interlinked. And in many ways, you can say that the reason the US has been able to pressure Europe and the EU to the extent it could is because Europe has substantially underfunded defense for decades, relying on the US defense umbrella. And so we found out that actually the world isn't such a peaceful place as we thought. Putin is right around the corner. He is rather belligerent. We haven't invested in our own defense, and the only real defense we have, or kind of the big umbrella, is the US. And so, Trump, he is saying, I want to pull out of Ukraine. I'm going to withdraw from NATO. I'm going to do all this stuff. I'm going to slap some tariffs on you. And kind of the subtext is, if you don't come to the table and make some kind of deal with me, you're going to lose the defensive umbrella. So to some extent, you can say the tariffs we are paying now is the consequence of not having invested in defense for all those years. Okay, so let's accept that's kind of the situation right now. And what the Germans are saying is, we got to change that for the future. We're going to invest in defense, and we're going to invest in infrastructure and national resilience. You mentioned kind of two of the schemes. There's the 500 billion euro infrastructure fund, the special fund, and then there's this Deutschlandfonds. And I think the Deutschlandfonds is interesting, but it isn't actually that much capital. I think it's only about 10 billion euro of government money, and the hope is that it'll be levered up 10-1 with private capital for strategic sectors in defense and energy and raw materials, etc. So it's all very interesting, but I think the bigger bazooka is on the infrastructure side, with lots of federal money for rail, for defense, for digital, for energy, as we talked about, which of course is critical in this new world. What are the implications for European recovery? Well, we need the German growth engine. For decades, it was the German locomotive that was driving European growth. And so since 2019, there's been no growth in Germany. And until that locomotive comes back and starts working again, it's going to be hard for Europe to get out of the doldrums. So I think this is extremely important. And I hope the Germans can pull it off, because without it, it's really going to be difficult for Europe to regain kind of the growth we all need.
I was just going to say, I think it depends for me on who decides what's going to be invested where. The bits I've read suggest that there's going to be supervisory. You can edit that for me, Dan. Supervisory board. Balance between state, labour, industrial representatives, private. There'll be fund management team, technical advisory committee. But as we've seen so often in Europe and sometimes the UK, states are not necessarily great at trying to behave like sort of innovative private capital. And I do often get a little bit frustrated that Europe and UK errs too much towards absolute control, centrist control. It's like, right, we've got to fix this problem. And rather than sort of pulling the big levers they have, which is incentivization, tax structure, removing friction, reducing compliance, reducing bureaucracy, they err towards actually getting down in the weeds and fixing the problem. Like, we'll pull together a team, we'll pull in some private money, and the government will help make decisions on what should get funded. This sort of classic industrial strategy approach. And I think there's a place for that on big infrastructure projects, but as we all know, the governments aren't very good at running those either. So there is a place for it. But when you're talking about which companies to invest into, which innovation and which startups are going to become the European Anduril, it really worries me when you've got government representation involved, because I think that's something the market does do best. And so, a lot of questions for me around actually how it'll be executed on. We've seen it already in this cycle within climate, where you've had, battery companies and others have large amounts of money pumped into them by government-sponsored initiatives, and then go belly up and fail. So yeah, that's a bit of a concern. And the headline numbers look good, but how are they going to be deployed?
I think it's spot on, Andrew. I think it's spot on. I'm very, very concerned about governments not being very good at allocating capital to commercial projects. I'd say you have a situation where in core infrastructure like transportation, like energy, when you are as underfunded as the European economy is, there can be massive unlocks from investment. And I think you look at German railway alone. I mean, I've seen data showing that it's approximating 300 billion euros of underinvestment. Okay, so it's practically broken, which means that you can't transport goods, people can't get to work, stuff gets cancelled. The cost, the drag on the economy is massive. And so I do think governments can play a role in unlocking some of these things by doing some of the fundamental stuff that should be easy. Now, you completely correctly point out some of the issues we've had around infrastructure investment. And I actually think we're going to touch on that. I think Dan's got a segment coming up around OECD and investment and growth, where I think we're going to touch more on this, because I think all of these things are interconnected in some way.
I have a random thought for you. Please shoot it in the face, which is I'm always intrigued as to how much of this is posturing. I was looking at the Stargate project, the $500 billion Stargate project in the States with OpenAI and Mayoshi-san and all these big names, and they all stood with Trump and were all waxing about how much money is going to be invested in the US. It's all been pared back. I don't know what's going to happen, what's going to come to reality over time, but for now it's been pared back quite significantly. So I'm wondering how much of the German story is the PR, the noise, that we are going to do 500, I'm back into my casually racist German accent, 500 billion euros of investment. Where, how, where is this money coming from? Where is it going to go? How is it going to work? So I guess the question is, what is posturing and what is reality? How much of this will be watered down, do you think?
Well, I mean, the German economy is what, 4.5 trillion GDP, and 500 billion over 10 years, 50 billion a year. You add that to kind of the national debt. I mean, it's not nothing, but it's also it'll be 10%, by the end of the day. This is a number that's eminently doable. It's not that it's not possible. I think the connection to Stargate is perhaps interesting, but I also think at the time the 500 bill was the headline number, of which I think 100 bill was the initial allocation that, of course, is going to happen in chunks. I think about 30 bill of that was into OpenAI, with kind of a further related to OpenAI and OpenAI data centers, and then a further chunk in other data centers. So, look, I think some of this stuff will roll out over time. I don't think the 500 bill is an unrealistic number. In fact, I think it's what we need.
Yeah, I think there is, and this is mainly to what Andrew bangs on regularly about, which is the markets are sentiment, and investing is sentiment, and it's energy, and I think it's regardless of the reality, almost not quite, but regardless of the reality, I think putting your foot forward and saying we are going to do big, bold, brave things. There's lots of money, and we're going to invest. I think is sentiment wise, I think is just a really, really powerful thing to do, which leads me on to my next question, which is for you, Andrew, which is obviously in the UK, we're now looking at autumn budgets. Reeves has said there's probably going to be tax rises, something that Labour pledged they wouldn't do. They've announced lots of investment strategies over time. Is there any space for more? Is there any money for more? Or is this all going to be an extremely depressing autumn, do you think?
I think it's going to be an extremely depressing autumn.
Oh, you miserable man. No,
It's really hard to see how you solve the problem by taxing more. And I know we bang on about this on this podcast, and it's not actually because I don't think tax is good, and it's not because I don't think corporates and the wealthy should be taxed. It's just you can't generate more revenue by continually tightening the belt and making our market unattractive. We've chosen to operate in a market economy, and that means we compete not just internally, but we compete on the global theatre to attract people to come and perform on our stage. And our stage is to start companies in the UK and to move here if you're an entrepreneur, and to invest here or stay here and pay your taxes here. So while there are some policies which might well be good. Canada and US both have exit taxes on cap gains. I think when people leave, and America's still doing great, right? You can make a case for taxes on global wealth in the same way America does. But it's when and how you implement them. And you have to do it from a position of strength, and you have to do it from a position of being an economy where you can make the wealth. People put up with taxes in the US because it's a fantastic place to make money. And the problem is in the UK at the moment that we're not balanced out with enough incentives. We're not an attractive place overall comparatively to run a VC fund and moreover, even to start a startup. And we used to be. And I think we've tipped the wrong way on that balance. So my fear is that in her desperation to balance the books, she's going to put the cart before the horse and try and increase taxes further to balance the books, rather than focusing on the medium term, which would be to implement policies which will grow the pie, so that whichever slice you take out of the pie is ultimately bigger.
I saw another report today on millionaires leaving, the non-dom challenge, some noises of perhaps walkbacks and some of the Labour policies. I saw that private equity carried interest has been at its lowest performance for best part of a decade. So I think all that leans very comfortably into what you're talking about there, Andrew. We kind of need that. We need, from a point of strength, and a proper investment noise and reality to then make the UK a really interesting, sexy, lucrative, powerful place to come and do business. Hopefully there'll be more of that in the autumn budget, but we'll see. We are going to stay with the UK. We're going to talk about UK rate cuts. So there has been the 5th rate cut in the last 12 months. I think sterling rose 0.5%. BOE cut rates 25 bips to 4% from 4.25. Inflation, it was a very narrow vote. It was 5-4. And I think it went through twice. Mads, I'm going to ask you on that one. I think it got voted on twice, because I'm not sure that it was clear the first time, or there were conversations still to be had. Inflation is still very sticky, 3.6, and it looks like it's going up. I think the last time I saw, they're expecting 4% in September. So these aren't great numbers to then consider a rate cut, which my assumption is that this is a preemptive strike at getting things moving again in the economy. But for the room, Mads, maybe you can kick off. What's happened? What's going to happen?
Look, I'd say, tricky to say what's going to happen exactly. I'd say, from a tech perspective, it's marginally positive for growth companies. But the real issue here is that UK growth has stalled and inflation is much too high. And even kind of normally with 3.6% inflation and inflation not coming down, you'd expect rates to stay higher and not be cut. And it's because given growth and growth being so sluggish, it's just felt that there was no option but to cut. And it's really not a pretty signal. It's a little bit of sort of sending up a red flare. So I think, coming back to, I think there are lots of things that could be done, but it's got a great look.
Listen, it's 25 bips. It feels quite small, but any thoughts maybe more around the startup in investing ecosystem?
Yeah, I mean, interest rates going down would be great because it makes VC a more attractive asset class. So if you're going to lock up your money as an investor for up to 10 years or even more in some cases, then you don't want to be able to put it somewhere liquid that is equivalent. You've got to have, there's got to be a reason to take the risk and a reason to lock up that money. So lower interest rates equals more money into VC, equals more money to startups. So that's something to be happy about.
All fairly marginal though, I fear. So let's talk more about investing, but not VC or PE. We're talking about corporate investing. The OECD has warned that weak corporate investment is threatening long-term global growth. That's the key story here, which is bad for everyone. So just to look at some of the backstory, investment levels have not returned to pre-GFC, pre-2008 trends in most advanced economies. Only Israel and Portugal have surpassed pre-GFC net investment levels. So both of those countries are on the same trajectory. Just 6 out of the 38 countries in the OECD, including Canada, Italy, and Australia, are above pre-pandemic levels. So on average, we're 20% below GFC trend, and then a further 6.7% below that pre-COVID trend. So why? Uncertainty, obviously a key drag here. Interestingly, the shift towards digital investments hasn't offset the real world, the physical asset investment world. So there hasn't been that offset play. In the UK, we've had the added challenge of companies maximizing for company dividends. English water companies, as an example, paid £83 billion in dividends versus £230 billion in infrastructure spend since privatization. So the big fat warning here from the OECD is, without a significant rebound in businesses investing, we will not see sustained economic growth. It will be impossible. So Mads, over to you. Is this context, is it meaningful? What's happening? Unpack for us.
I think it's super meaningful. As we know, productivity of many countries, including the UK, stalled at great financial crisis in 2008. And with stalled, I mean it has not really grown at the rate it used to. And when the productivity of a nation doesn't grow, GDP doesn't go up unless you import lots of labor. And so when productivity is not going up, we're not getting richer, we're not getting more wealthy. And so we're lacking all the money we have to invest in all the things we want to invest in. So that's not great. There's an argument made that a lot of investment is being made, but it's just not showing up because it used to be investment in machinery and plants and buildings. And now companies are investing in software and intangibles, and in many situations that's running through the expense account rather than going onto the balance sheet. So it's invisible in the accounts. Now, if you follow that argument for a minute, there's a further argument that says that there's a broken transmission mechanism, because there is this paradox. On one hand, we're investing perhaps more than ever, right, in information technology, and we should be incredibly productive and efficient. And in many ways, we are, because we are very efficient. But there is a challenge, which is that a lot of the productivity gain has been absorbed by regulatory complexity. So if you think about it, this is back to the German talk from earlier, it's back to some of Andrew's points. We built the perfect tools for sharing information and for coordinating things, but they're also perfect tools for blocking. Everybody can object to everything. There's freedom of information. You can, FOI everything. You have endless consultations. Everybody can access all the documents from home, and you can create a lot of rigmarole. And that means you have decades of planning for just a few years of building. Kind of some examples of that, we have HS2, started in 2009. It was originally meant to be a £33 billion project, and now it's more than £100 billion. And kind of the rail line has been chopped in half, and kind of completion time has been pushed up to 26 years. We've already spent more than the entire original budget, even though half the project has been cancelled and the other half hasn't nearly been finished. And kind of the other example is the Lower Thames Crossing, right? It was 16 years of planning has been taking place. We spent more than £1 billion on consultation and redesign, and that's before building anything. Some of this it just means that you have massive cost overruns in some of these projects, and everything becomes very, very complicated. So Germany's rail is in decay. It's in desperate need of investment. British infrastructure is the same. And so I think what technology can offer us is really a liberation from all of this. AI could do years of planning or in weeks. Digital twins can test the infrastructure, right? We know that autonomous cars will transform mobility. When we get to it, quantum computing can completely optimize the entire transport network. But we really have to roll back some of the regulation we have hemming things in. If we can become more streamlined than planning, we can build a lot more. And to some extent, it's not about a lot more money. We do need capital, but we also need to roll back some of the regulation. And I think the US has really shown the way for some of these things. In Texas and Arizona, there's been a will and a desire to say, look, we need to build again, and we need to make it easy to get permits for data centers, for power generation. And there's no reason why we couldn't do that in Europe. And if we do, I think growth will return. So that's where I would look for the growth we talked about.
So build, baby, build, drill, baby, drill, unplan, baby, unplan. Andrew, what would you add to this conversation?
I have no perfect data for this, but I do wonder whether we've stumbled into a world where companies would rather please shareholders on a quarterly basis than build the future. And, and then we're surprised when growth sort of runs out of steam. So I guess businesses as a whole, we have the data built, businesses are holding back on investment. I think you're quite right that despite low capital costs, relatively speaking, there's a huge amount of policy uncertainty, economic ups and downs. Nobody really knows which way things are going. And I think that results in a lot of short-term shareholder pressure. I just feel that, again, we need to go back to fundamentals and think about what makes companies successful and build accordingly. And that takes real leadership, right? That takes CEOs, be it of corporations or of startups, who have vision and are willing to risk their own reputation in attempting to execute on that vision. And you get a lot of caretaker CEOs who are happy to just try and keep cranking the handle rather than take risks, because why would you ruin your reputation and your massive pay packet and your massive bonus? Much better to just, not take too many risks and keep tootling along. But as the world becomes more unstable and unpredictable, that won't work quite so well.
How will this affect us, Mads? What's going to happen in venture? Is there an opportunity here? Is there more to be done in private markets because the publics and the big guys are so lazy, dividend focused, shareholder happiness focused? Is there, maybe I'm reaching here, but is there something that we can ponder?
Look, we're funding the tools and technologies that can unlock all of this. I'd say every regulatory bottleneck is an opportunity. And when the dam breaks with some of this stuff, deployment will be explosive. And I'm hoping that European governments will wake up and say, okay, actually now the pain is so acute that we have to take action. I think, Starmer, he started with some of the rhetoric, around the time of the election last year, but has sort of more or less been bullied by the parliamentary Labour Party into submission, and it looks like has given up on some of the reform agenda. But I don't see that pattern holding across Europe. At some point, something will break. At some point, bond markets are going to go, look, unless you start reforming, unless you start deregulating, reallocating more resource from just your pure welfare spending into investment in infrastructure in the future, we don't believe that you'll ever be able to repay your debts, and interest rates will spike, and you're going to have threats of default, right? And so I think at some point that will happen. The question is how long. I don't hope any of the economies will face that, but I also think maybe if it does happen, it's better sooner rather than later, because we do need a wake-up call for the transition to start to take place.
Well, bonds have been, UK gilts 10 years have been pretty static, stable. Last time I looked, for the last 6 months. So, I don't know, calm before the storm. We'll see.
Steady as she goes, right? Steady as she goes.
Okay. Well, let's talk about the European Chips Act.
But just try and pursue that. What we've seen over the last year was kind of starting out as, look, the grown-ups are back in charge, we'll be sensible, we'll be steady, we'll make, quote-unquote, some small tax rises, take the pain to do the necessary thing. But we've entered a bit of a death spiral now, and everything you see is inflation going up, growth going down, and deterioration of the public finances. That cannot continue. That's not sustainable. You cannot keep raising taxes forever, right? You've already seen an exodus of entrepreneurs and the affluent, and tax receipts, as you said, have been decreasing in some areas. Like, obviously, the more you keep increasing rates, that will come to an end.
I just wonder at what point it's such a political quagmire that the desire to hold on and not rock the boat too much just becomes the tour de force and the way that the way that Reeves will run the economy. So I
think if you look from a narrow UK perspective, I fear you're right for the near term. But obviously there are many countries in Europe, and I think some will take the lead on this.
Should we become German? Should we just change passports? I think I might move to Berlin. Andrew, sorry I interrupted you.
I was just going to agree that I think Rachel Reeves showed her colours from the beginning, and so she's ideologically rooted. She's not, much as she might think she is, she's not looking for the outcome. She's being driven by the ideology, and that's politically driven as well. So that's a huge, unless you are passionately determined to risk your own skin to get the outcomes for the country at the, and to take on the trade unions in doing so, and to take on all the political commentators in doing so, and to take on your backbenchers in doing so, then you're not going to. And she's already shown she hasn't got the stomach to do that. So she's sort of trying to tread this path of, her own fiscal rules combined with not upsetting her backbenchers, not upsetting the Labour Party stakeholders and the grassroots base, but also not being accused of ruining the economy. And it's just resulting in, we're drifting, and that's the problem.
And then we get stuck in the 50 billion pound black hole conversations, which I can't quite work out why we're paying interest on to the banks. But anyway, that's possibly that's another conversation for another time.
Yeah, no, and just being at risk of splitting hairs here, but maybe just for argument's sake, I'm actually not sure that she is that ideologically driven. Andrew, stay with me for a second. I think she did two things, right? She felt she had to give the left of her party some red meat, and those were two things. It was VAT in private schools, because those damn affluent people at there send their kids there, for aspirational purposes. We need to give them a whack, and more tax on carried interest and cap gains. Okay, and I think she thought that was enough to buy them off and give us some peace. But what actually happened was it showed weakness, and now they smelled the blood, and they've come back for more, to the point where that party has now become ungovernable. And what we saw a month ago when they tried the welfare reform, it was clear those reforms were sensible, but were absolutely annihilated by a parliamentary Labour Party that has no desire for reform. So I'm not sure that it is her ideology as much as the ideology of a party that is frankly quite left-leaning. That is what I see as the real risk.
You've made a really good point there, because another way of putting it is that Labour Party has been split and doesn't have a clear mandate to lead before it even went into government. It had a long time to sort itself out in opposition and didn't. And so it was sort of patched up the differences in order to get into power. And then now you get this jumbled up policy, and it's not just Labour, by the way. The Conservatives for years have been no better. They've claimed to be the party of a sort of commercial acumen, but then spent the North Sea oil and gas tax windfall on tax breaks back in the day instead of starting a sovereign wealth fund. They sold off the post office cheap. They've done multiple private sales of government assets at low cost, which is not the way to make not make the way to make the nation money.
Brexit.
So they're both as bad as each other,
right?
The B word.
Well, yeah, I intentionally avoided that because I just think you get nowhere having that conversation. We've done it now, so we need to get on with it. But even at these very clear cut, what you could describe as business decisions, where you have a profitable post office and there is a market value to that sale, and you grossly undersell that asset to the benefit of the private investors. You're not protecting the interests of the country, and you have to work back from that, right? We all want more money in the government. Great. We all want to get rid of homeless people off the street. Great. To do that, we need more taxes. Great. Then there's an argument about how you get there. And the problem is the Labour Party make policies that don't get you there because they're ideologically driven, which is it's the fault of the rich people. Let's tax them. And then Conservatives do it from the position of everything should be privatized, and the government can't run anything, and they just hand money dish money out to private shareholders, so they don't get there either, and it's exceptionally frustrating.
Yeah, water utilities is a case in point. It's a farce.
100%. About 20. Yeah, I mean the trains are the same as well. About 20% subsidy. Guess how much the dividends have been for the past 10 years? Train companies, about 20%. So you might as well save 20%. Have the UK run it. Save the taxpayer 20%. Not hand that cash over to the private shareholders. It's insane.
I was looking this week at Norway's sovereign wealth fund and just trying to work out where the money came from and how they got to the vast trillions under management that they have. And I didn't realize that the UK and Norway shared the North Sea oil and gas fields.
100%.
And what Norway did was get very smart at building a sovereign wealth fund. And what the UK did was the complete opposite, and it all dissolved into a world of nothing. We had the same resource, we had the same potential.
And not only that, it's now the world's biggest, most successful sovereign wealth fund. Yet it was only legislated. It was only started in 1990. It didn't deploy capital to 1996. So that's how new that fund is, and it's now.
What is it now? 1.4 trillion, 1.6 trillion.
I don't know the numbers on the top of the head.
Anyway, depressing.
Shoulda, woulda, coulda.
Shoulda, woulda, couldas. And that was under the Tories. Oh no, that was Labour. That would have been the Tories. European Chips Act. Let's move on swiftly before I swallow my words even more. Massive fail. I think that's the tee up to the topic. So the European Chips Act was introduced in 2023, so it's a very recent thing, and the aim was to double Europe's chip production, get to about 20% by 2030, but it's not doing anywhere near that. And it looks like by 2030, it could be as low as 5%. Intel and others have pulled out, citing red tape and other better opportunities elsewhere, as in Vietnam, Costa Rica, and other places. Also, the EU focused on low-end chips which weren't cutting edge and limited global competitiveness. A poor trade deal with the US and looming global chip oversupply worsened the whole situation. So this has been a bit of a catastrophic fail. However, we are now looking at the CHIPS Act 2.0. They're trying to reinvigorate something new. So Mads, what is it? Will it work?
I don't know if it will work, Dan. It's...
We need some upside.
Yeah, no, I mean, it should work. And I think the context is that we can't give up. Yeah, but the EU is targeting 20% global market share by 2030, might hit 5%, right? So, I mean, you could sort of argue about, is it even worth doing? I do think it is. We know that Intel pulled out because the previous program was not structured correctly. Intel probably wasn't the right partner anyway. We also know that Trump has just announced semiconductor tariffs. The whole idea there, of course, is to force more of TSMC to the US. I think there is a real strategy needed. I think we've seen the playbook from China, which is that when you're behind in certain strategic sectors, you need to force and or encourage foreign leaders to manufacture locally so you can transfer knowledge and become good at that thing. We already have extreme market leadership in some areas, whether that's ASML in the lithography area, whether that's ARM in the low voltage chip design. We need TSMC equivalent manufacturing in Europe, not just commodity chips. And this is about strategic autonomy, not just economics. And so what should a new act do? I think it should leverage the great supply chain we have around ASML. For example, you can say we'll give TSMC preferential treatment if they build fabs in Europe, so we get that knowledge transfer. You can create incentives for TSMC and Samsung that are the leaders to build cutting-edge fabs here, and perhaps you need to put some tariffs on if they don't. So I think you can learn from Trump. I think you can learn from China, and I think we must have some of that transfer, tech transfer, knowledge transfer happening.
Andrew, I was going to ask you, should Europe focus on silicon? I think Mads has covered that quite nicely, but I know you're a big sovereign, manage your own affairs chap, but what angle would you take on this?
Yeah, I mean, I agree with Mads. It stumbled, but I think because it spread too little money across too many players, slow approvals. I think 3 billion came centrally from the EU, and then the money was being pulled from a bunch of different pots, nation state pots. So decisions were protracted. If you compare that to the US CHIPS Act, you had, I think, the Department of Commerce led sort of top-down deployment actually, and also very focused. They were focused on the advanced track size, and specifically with a bias towards AI and defense, whereas there was a whole different set of focuses, including the cheap stuff which we can't compete against Asia. So a combination probably of poorly conceived outcomes and goals, and slow and poor bureaucratic implementation. And so unless that changes, unless those things are really tightened, focused, and are the way we actually think about deploying the cash, then I think risk is just repeating the same problem. And you see this culturally reflected. It's almost a mirror if you look at we touched last week on the AI battle plan, as Mads wonderfully called it, of the US, where it focused in on geopolitical imperatives and sort of cutting edge capabilities. And it just feels a little bit the same, right? It feels like, you've had too many people making too many decisions, trying to cover all bases in Europe, trying to cover all stakeholders all the way from, we need to be able to produce the cheap chips, but also the expensive chips, and, make sure all policy variables are covered. And that just makes for a very hard thing to build success on.
It does feel like a slight timing issue. I mean, if you think about ChatGPT, November 22, obviously the CHIPS Act was being discussed pre this kind of new wave of incredible AI innovation. So it feels quite that there was a timing issue. Is that fair?
Sorry, timing issue of what?
So I'm trying to unpack. It looks like obviously the CHIPS Act 2023 feels very recent, but in AI terms, in silicon terms, and in this kind of new AI push terms, it's not. It's almost like in dog years. So I'm wondering if the original policy wasn't as doomed as we're labeling it as, because there was also this timing issue as to what these chips actually are, can do, and how they can be applied.
Well, possibly. I think you're facing two other issues, to be honest. I mean, one is this issue of planning and regulation we've already talked about, where it is so bloody hard to get anything built in Europe because of planning, because of lack of power, because of a lot of connectivity and everything taking so long. That's the one thing. The other thing is you've got a partnership with Intel.
Yeah,
I mean, Intel
they've
is
got their own issues, haven't they?
Well, the company is facing an existential crisis. It's probably the last partner you'd want for next-gen cutting-edge technology right now. I mean, there are two players, right? There is sort of Samsung, if you squint a bit, and then TSMC, which is without them, nothing. So you got to get TSMC in here. I mean, you got to, right? We already have the ASML sort of, baseline. There's so much to build on. I think there's no excuse for not making a close partnership with TSMC. But what's happened is probably that you've had management by committee, you've had local players say we shouldn't favor those kind of foreign companies. It's better to strengthen Infineon and other European semiconductor companies, and we've got to think about the automotive supply chain, and everything sort of gets subsumed into, as Andrew says, some other weird industrial policy that tries to please everybody, as opposed to thinking really strategically about what it is we need to do to win.
On the bright side, trying to pull something positive out of the ambition for a new CHIPS Act is, I don't think it's too late, because we think today that we're surrounded by technology, but robots are going to be as prolific as mobile phones are, if not more so in our future, within our lifetime. So the issue of chip capacity and chips in general is not going away. So I don't think actually it's too late. But again, it's about ambition, and it's about matching the economic realities to what you want to build. And given the labor costs in Europe, you're not going to successfully probably produce super cheap chips compared to some of these Asian countries. And you want to focus on the stuff that's going to create IP, and actually where a lot of the bottlenecks are for creating the high-tech stuff that we need, be it defense tech or AI tech. And that's the stuff we should focus on.
I completely agree with you, Andrew. Absolutely. It's not too late. I would say my concern is that things are going to go the way they often do in Europe, which is we say we have to be sensible. We have to level the playing field. We have to be fair to everybody. And you sit down and go through a long process to try and create a policy that in an ideal world would attract companies to Europe and set up, and it looks nice in a spreadsheet. But there is only one company that matters. You have to work your way backwards and say, what will it take for TSMC to create major manufacturing capacity in Europe to manufacture the best 2 nanometer chip technology here? And the technology that makes that happen
just
is
can't
the right
get over
is
it. Isn't it extraordinary that AMSL, like the company that builds the machines that build the damn things, is based in the Netherlands? Isn't that just insane?
They're just
we can't get our shit together.
They don't build.
No,
they just design.
No. They make the machines that make the stuff.
Oh, I thought they were just the design. Then there was somebody else that made the machines that made the stuff, and then TSMC
got the most advanced machine in the world.
All we need is the policy that attracts TSMC and attracts them and makes it a necessity for them to make chips here, and then it removes any kind of regulatory impediment to making it happen. It's those two components.
It's the 5 nanometer and below, Dan. So it's the lithography machines using sort of extreme ultraviolet light, which allow you to make these very, very high-end chips.
But it's okay. Don't forget, it's okay because Trump has got everybody now to produce everything in the States. So our next iPhone is going to be at least $4,000. So that'll level the playing field for the rest of us to then catch up with building all these technologies so that we can compete with a $5,000 laptop. So don't worry about it. We'll be fine.
But going back to your previous point, Dan, because that $4,000 iPhone probably won't be any different to the last 5 versions of the iPhone you bought, thanks to Tim Cook. So it's just you have a non-cracked screen, and battery life will be slightly worse.
Never leave the accountant in charge of innovation. I want to stay with AI. We have AI Corner. This has been a mega week for you, Mads. We've got loads of juicy stuff to talk about. Chat GPT-5 could be dropped as we are recording Thursday, the 7th of August. I'm not that hopeful, but you never know. Sam Altman said soon. and showed it running on his computer. Although I'm not quite sure what it is, but maybe, Mads, you know. We waited for a long time for this. Meanwhile, Anthropic has dropped Claude 4.1, and the foundational model wars continue. OpenAI released ChatGPT OSS, its open source model, their first since GPT-2 5 years ago. So lots more, again, more product release from OpenAI, all while there's mega rounds all over the place. OpenAI raising another 8 billion, Mistral targeting a 10 billion valuation, and Perplexity looking to raise again, although not, I don't think, a major uplift. I also want to talk to you about LLM decomposition. So I'm going to lean on you, Mads, to unpack what the heck that is, because that's super interesting. And we are also looking at infrastructure in Norway. OpenAI has launched its first data center in Norway. Okay, you're not in the EU, but in Europe, and we'll take it. So what is that regulatory arbitrage? We don't know, but we'll have it anyway. So Mads, over to you. I don't know where you want to start. Maybe ChatGPT-5. Maybe we should start there.
Of course, it's super interesting for all us AI geeks. I'd say Sam Altman has, on one hand, OpenAI is still the juggernaut, right? It's still the leader. Anthropic has been doing really, really well. And open source is starting to look scarily good. So he is under immense pressure to produce the goods. Let's not forget, as you're saying, he's looking to raise another $8 billion. And yes, he's got something approximating a limitless ATM at the moment, but nothing is truly limitless. We know that. He's got to deliver. So the truth is, GPT-5, it's been 18 months of waiting on this incredible model. It creates almost impossible expectations. When it comes and when the model comes out, we're all very excited for it. I think it's going to be very, very good. I do think when we take a step back, incremental improvements perhaps matter more than breakthroughs. There will be much better reasoning. There'll be much better multimodal integration. But adoption depends on reliability, not on benchmarks. And we've seen that when it comes to reliability around coding, nobody's been able to beat Anthropic this year. And so the big question is, can OpenAI start to make a dent in that or not? The other big question is the open source versus closed source strategy. And I covered this a few days ago on my August blog. Open source will eventually win. I have no doubt. Like Linux, you cannot compete when you have a combination of open source and the amount of money you have behind open source. This is not just a few hobbyists, right? These Chinese open source competitors, each of them are funded with at least $1 billion. They're all sharing code. Everybody's training. Everybody's learning from everybody else. It's pretty crazy. But we can also see that even with those incredible models they're churning out, OpenAI and Anthropic have continued to grow revenue. And why is that? They've got a lot of application-like functionality on top. OpenAI has got incredible memory today that's built in. Anthropic has got things like Claude Code, and it is just so unbelievably good. Most people in the software industry use it to write code. I use it for a bunch of things that's not even about code writing. It's just such a beautiful tool. And that's much more than just a strong LLM. So I think to the extent that OpenAI, they've now released an open source model, and there'll be great open source models, and they may eventually be better than the closed models. But all that value is now starting to accrue in the application layer that sits on top. And that's super, super exciting. Happy to unpack that more, or we can jump to some of the IP and decomposition stuff we talked about. But I don't know if you have any follow-up questions.
Yeah, let me bring in Andrew, because Andrew, you're always a bit of a not a naysayer on the LLM front, but you've always got a bit of a counter to the LLM. So I don't know if you have an angle on proprietary versus open source or anything that's going on with ChatGPT-5, but over to you.
Yeah, proof will be in the pudding. I've not kept up with what is actually, I'm waiting for the launch like everybody else. But I think for a while we're going to have both. And to some degree, I would suggest that OpenAI have been forced because you have enterprises who want on-premise who want more control. So to keep up with the Joneses, they've had to do that. And it's a bit of a double-edged sword for them, because obviously that eats away at their API revenue, and it releases some level of control. But they don't really have a choice, because competitors have been doing it. I think we'll see this ebb and flow for a while. I'm more curious about whether there continues to be step changes in capability, or whether we see a sort of a slowdown in capability, and it becomes more an iterative release cycle.
That's my take. My take is there will be a plateau in our not too distant future, but maybe Mads, you're anti that for the meantime. But well, actually, Mads, anything else on this before we move on to decomposition?
Yeah, I mean, there's another interesting angle, perhaps, which is that we sometimes think that open source means free, means nobody makes money. But as we will recall from Linux, although Linux theoretically was free and everybody could go and download a Linux distribution for free online, it turned out that corporates still wanted somebody to call when things went wrong. And Red Hat managed to build an incredible business on the back of that. And IBM acquired that company for $34 billion. Now, today, with Gen AI, physical AI on the horizon, I mean, everything's going to be at least an order of magnitude bigger. Put a zero on that, that's 340, which incidentally is approximately OpenAI's valuation today. So to Andrew's point, I think OpenAI has been forced down the open source route, but there is definitely an argument to be made that they could end up monetizing that if they can no longer monetize the API calls as they do today. I do think that there is a road to walk today. Obviously, the API business selling tokens, both Anthropic and OpenAI, are making great hay doing that. Anthropic have grown from $1 billion to $5 billion in run rate revenue just since the start of 2025. I mean, staggering growth of business.
People don't know that. I think maybe people don't know that the original, back in the early 2000s, the original kernel for OS X, the baseline for the new Mac operating system was open source. So there are obviously mega commercial applications to open source things, and there are many, many examples of that. Andrew, I interrupted you.
No, just to say, not to disappoint, you're labeling me as a naysayer. I mean, the problem with most of these models, be it the centralized or the open source, is that certainly without a lot of guardrails, they still make copious numbers of mistakes. I use AI every day across a whole range of business applications, personally, advice from trivial things that you might use Google for, all the way through to sort of processing decks and doing other more complex bits of work, and it still hallucinates incredibly badly. He's still
you're using the wrong models, baby.
I'm not. I'm using all the latest stuff, and it still pulls in stuff from the past randomly. So you still need, if you're going to have enterprise grade solutions in place, out of the box, it doesn't work right now. You've got to have a lot of guardrails around that. And
There's an AI for that.
I still don't see how that's changing in the future. But it kind of goes back to your point, Matt, which is, a lot of the value is shifting into the application layer and how this technology is deployed. And you do need a lot of a richer feature set and safeguards depending upon what sector you're working in.
Let's get into decomposition. This is a really interesting topic. I mean, the Cisco Talos research on decomposition isn't just about security. It proves that LLMs can reproduce training data verbatim. So this is destroying the no copyright infringement argument. So Mads, tell us more about IP and decomposition.
To some extent, it might seem a bit esoteric to some, but when you unpack it a bit, I mean, what's the secret sauce of an LLM? Look, you've got some very powerful models, and the algorithms are very, very cool, no doubt. But of course, all the magic that goes in is data. And the data that's being trained on, well, it's internet data, it's, all the stuff that's happening there, but it's also increasingly copyrighted material, right? That means books, it means, films, it means anything where anybody has written anything. And so there's sort of been a rather spurious argument saying that it's not real copyright infringement. That's an argument that's especially espoused in the US, where people are saying, well, it's kind of reasonable use, because all I'm doing is it's like going to the library and reading a book or reading 10 books on a subject and then becoming really good at it. And then I can go and I can create more knowledge. And that, of course, is not violating copyright. That's just me learning. And then suggesting that that's the same in the world of AI, because really the AI is just like going to the library and reading all these books and then learning new things. But it turns out that an AI brain is not really like a human brain. It has photographic memory. It recalls everything. And so it's this weird analogous thing of it can actually act as a photocopier. And that is what this new research has shown, that you can get an AI model to spit out exactly the training data that's been used, which I think completely destroys this argument of no copyright violation. Now, there is another argument which I think probably has more merit, which is that the Chinese models and Chinese model companies they train on everything. And if they can train on everything, and if Western model developers can only train on a few things, or things they bought the rights to, then China will win the model race, and that's the end of it. And there's an argument to be said that we just can't afford that to happen, and therefore we need to think about copyright in a different way when it comes to AI. To some extent, you can say this is already priced in, and the courts will take years to catch up. And the real question is, does it matter if models commoditized anyway? I do think the world of content as we know it today, it's going to look different. We've already seen a huge shift right away from mainstream media to new media in the form of podcasts and things like it. So I think people that have lived off creating and publishing content in the past will have to think of new business models in the future, whether that be music, TV, books, or other things.
Andrew, you're chomping. I can see you chomping at the bit there.
It reminds me a little bit of the Napster days back in early 2000s.
Yeah, love Napster.
DRM tried to protect music long after MP3s had gone sort of mass market and viral. And when we think about what happened, it might be a clumsy analogy, why did LimeWire or one of the other sort of clients for Napster, why were they beaten by Spotify? And I would probably argue that it's because ultimately Spotify was a better user experience, easier to use, more readily available, better supported. So often this stuff, sometimes comes down to almost a user experience issue and an availability issue and an ease of use issue, because it's already happened. The courts and law moves so slowly that we're discussing the legal implications of something that's already happened, not something that's about to happen. And that's exactly analogous to what happened really with the music industry. So it'll be interesting to see how it evolves, but early days.
I think what the analogy is different. I think what happened with Napster is Napster was actually shut down. And you're right, all the alternatives sprang up, but Spotify produced such a good alternative that the music industry was able to recover some royalties. And no, this business of selling CDs was destroyed forever, but some revenue came out, and some of the top selling artists do get something. Whereas I'm not sure that will happen here.
But BitTorrent and everything else still exists. I mean, I've got friends who still, torrent their movies. I don't, because I can't be bothered. I just pay the £4, right? So, and there's a lot of people who still do that. So I think the analogy is still valid, which is the mass market. Most people turn on their TV. The movie's on there. It's baked into their TV set. They don't want to move on the sofa. They don't want to think in advance. They have to set a torrent going, and tomorrow it will be downloaded off a bunch of distributed nodes. It's all too complicated, and that's why it amazed me that it took so long for movie licensees and music licensees to just realize that just stick everything online, make it easy, and charge people. People will pay because it's easier. So I think we're at a similar point of inflection with the LLMs.
So you can see a future where media companies, they'll be able to go back to getting charged for their IP.
Potentially, but the one difference is that it depends what you call IP. When does something become not what it was originally? An LLM produces, well, you would say wisdom, Dan. It produces smarts and wisdom. I would say it regurgitates, a bunch of random predictions.
There is no free will, my man. There is no free will. So that's all we're doing. We are all regurgitating machines.
Exactly. So an LLM regurgitates something, but it's all based upon the teachings from before. So it is different in that respect. But I think the human behaviors still apply, which is that people tend towards ease over motivation.
I don't know. I'm not quite sure that's the right context, but we need to move on because we've run out of time. Mads, what else is going on in AI Corner? There's some other mega rounds, right?
Other big rounds. I mean, I think you've talked about the OpenAI round, the Mistral round, the Perplexity round. I mean, companies are raising, things are happening. Look, we're very, very much still in sort of the heyday of AI and the AI boom. I don't see that slowing down anytime soon.
No, I mean, every week we have a mega AI corner, and I absolutely bloody love it. And we live at the application level, which is just coming to force now. So it's a super exciting time to be alive, especially for us, just to be extremely selfish for a minute. Right, we've got a few quick deals of the week. I'm going to kick off with Clay. Clay are doing 100 million at 3.1 billion. We use Clay. Clay is an awesome tool. So I wanted to just give the Clay team a big shout out. Keep going. What an incredible thing. Mads, you had a couple of things on your docket.
Yeah, we talked about N8N's Series C last week. I think we set 1.5 billion euros at the time. I think they've now reportedly had more than 10 term sheets come in, many offering a valuation north of 2 billion. And so that's just great to see something that historically would have been a company coming out of Silicon Valley is made here in Europe. And it's a beautiful, beautiful application for those who haven't used it yet. Really, really well made.
American investors though, right? Isn't it Index and Lightspeed? Who's fighting for the round?
10 term sheets. I think it's from 10. All over the shop, but there will be a lot of US firms in the mix, and that's fine, right? I mean, I think it's great that we can build stuff here, and the whole world wants to invest. The other deal of the week I wanted to have a quick shout out for was Voltrac. It's a Spanish based. Voltrac. It's a Spanish based agtech defense company. They made an autonomous electric tractor. It's big. And it's interesting because we've seen some really, really cool things coming out of China, but actually this one looks like it's super, super smart. It's an ex-Google X engineer who is working with an ex-Destinus aerospace engineer. Very, very streamlined design, 70% fewer components than many other alternatives. Farmers can repair them on site. In terms of the return on investment, so it's reportedly 30,000 euros cheaper than a diesel equivalent per year if you think about the operating cost of not having to have somebody sitting there and driving it.
This leans into Andrew's everything's going to be a robot. I mean, I
absolutely,
totally buy it.
It's physical AI hitting real applications here in Europe, right? So I think it's a great thing.
Andrew, what's on your docket?
I don't have a deal, but I'm going to continue the theme from my last show where I talked something weird about
Not raccoons.
AI.
No raccoons. Come on, man.
No raccoons this week, sadly. But we talked last time about the impact of AI and doing deals with government. And just yesterday, the Prime Minister of Sweden was quoted on a news broadcast that he uses ChatGPT to get second opinions before he makes decisions. So, a very honest sort of declaration there, which he was obviously dragged through the mud for. But I think it's a really interesting data point.
Why was he dragged through the mud? I guess it's deferring brain capacity, but it's not really. It's not
deferring. It all comes down to what he's asking. If he's cutting and pasting decisions, policy decisions, or saying other stuff, he's putting that stuff into
it might be bloody smart, right?
It might be really smart, but do you want your prime minister beholden to an American LLM, and do you want that American LLM storing that information and that data? I mean, it's lots of interesting questions.
We had exactly the same debacle in the UK 6 months ago, where Peter Kyle was shut down for using ChatGPT to do research, and it's just so dumb. I mean, if you can't have your leaders use smart technology to make better decisions, I mean, then what does it come to?
It's the same as they all did drugs at university, but they never inhaled. So it's the same, nothing to see here. We're not human. We don't do anything. We just automatons. We do what you tell us to do. It's like, come on, we get the leaders we deserve. Right, gentlemen, you lovely humans. Thank you so much. This has been Upside, and we'll catch you next week.
Bye. See you on the next one.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.